Welcome to The Explainer. Today, we are completely ripping the facade off the financial industry's glossy marketing. We're going to look at the raw, unfiltered math behind the two biggest financial machines in your life, buying a home and investing your money. No fluff here, just the exact, real-world numbers you absolutely need to understand how wealth is actually built and, honestly, how it's lost.
Let's start with housing and the profound cognitive dissonance of the modern economy. Picture two people living in the exact same city, chasing the exact same dream. One makes $65,000 a year, the other makes $120,000. They both walk into a bank, both get pre-approved, and both buy houses. And yet, within 18 months, both of them are quietly drowning. Why? Because getting approved for a mortgage and actually being able to afford that mortgage are two completely different things. The industry hands you numbers designed to make a sale look smart, but as you'll see, those aren't the numbers that govern your daily reality.
Okay, let's dive into this. You've probably heard the golden rule of personal finance. Spend no more than 28% of your gross income on housing, right? Well, back in 2012, when median homes were around $175,000 and mortgage rates were 3.5%, that rule worked perfectly fine. But rules break when the variables change by 150%. The fundamental flaw here is the focus on gross income. The real math, the math that actually keeps you out of trouble in the 2026 housing market, has to be based on your net income, your actual usable take-home pay.
Let's run the actual numbers for someone earning $80,000 a year today. If they buy a $280,000 home, which by the way is well below the national median, their mortgage, property taxes, insurance, PMI, and a very modest maintenance reserve comes to about $2,700 a month. Now, on an $80K salary, your actual take-home pay is roughly $5,000 a month. Run the division on that. You are spending 54% of your real spendable income just to keep a roof over your head. That's before you buy a single grocery item, pay for childcare, or even look at a student loan statement.
So why on earth did the bank approve this person? Well, because lenders operate on a metric called debt to income, or DTI. They look at your gross income and your existing debt, and legally they can approve you to spend 43% or sometimes even up to 57% of your gross pay on debt obligations. But remember, DTI is the bank's ratio, not your reality. The bank isn't modeling your utility bills. They don't care about your car insurance or the fact that your HVAC system might literally explode in the middle of winter. Their job is just to maximize the debt you look capable of carrying on paper.
And this brilliantly illustrates what happens when we step away from the bank's fantasy and cap total housing costs at a safe 35% of your net take-home pay. The whole picture changes. Take a $100,000 earner, for instance. They can realistically afford a home priced around $234,000. Yet the national median home price is pushing $440,000. The stark reality is that to buy a median-priced American home today, without stretching into extreme financial fragility, you genuinely need a household income between $130,000 and $150,000 a year.
And listen, that's just the monthly math. We haven't even touched the invisible costs that show up on move-in day. You've got closing costs, extracting 2 to 5% of the purchase price right out of your cash reserves. You have moving expenses. You've got the moving gap. You know, the reality that every new home magically requires a dozen immediate trips to Home Depot for things like window blinds, lawnmowers, and light bulbs you never even thought about. And worst of all, the deferred maintenance bombs. You aren't just buying a house, you're buying its entire history of ignored repairs. This is the debt machine at work, quietly draining your savings and generating some profound psychological stress.
But there is another machine, a much quieter one. Let's pivot from the debt machine of housing to the wealth machine of long-term investing. Look, most people will never be rich, but it's not just because the economy is tough. It's often because of something deeply personal. They just couldn't stand watching nothing happen. People fail at wealth building because the process looks completely broken at first. They pull the plug right before the math actually wakes up.
We're going to track a very simple, totally unglamorous mechanism right now. $500 a month. We're not talking about some massive six-figure surplus, just the cost of a standard car payment. We are putting that $500 every single month into a broad market index fund tracking the S&P 500 for 25 years. We're assuming an honest, historically grounded 8% average annual return. Let's watch exactly how this capital accumulates over time.
This is your 25-year wealth odyssey. It starts with the invisible years. In your first 3 years, you invest nearly $20,000 of your own hard-earned money, and the market adds a measly $900. I mean, the progress feels almost insulting, right? Statistically, this is exactly where a huge chunk of people quit. They expected a massive signal, a huge reward, but all they got was silence. What they don't realize is that the silence is the signal. They are building the foundation of the machine. And then, right when you're finally gaining momentum, the crash arrives. Let's say it hits in year 8 or 9. Now listen closely to this. A market crash isn't a risk. It is an appointment on your calendar. When the market drops 35%, your balance plummets. This is when the second wave of people panic and exit. But the brutal, beautiful arithmetic is this. When the market falls 35%, your consistent $500 monthly contribution buys 54% more shares. You are acquiring identical, world-class businesses at a massive discount. Your contributions during a crash do infinitely more compounding work than your contributions during a peak.
Now, what's really interesting about this slide is how an incredible power dynamic completely flips over time. In year 5, your wealth is mostly just the cash you put in. By year 15, we hit the halfway point. It's an equal split between your contributions and the market's returns. But skip ahead to year 25. The market's influence absolutely dwarfs yours. You have officially become a minority contributor to your own wealth. The mechanism you fed quietly through all those crashes and boredom is now doing dramatically more financial work than you ever could.
By year 25, your account sits at roughly $490,000. Your total personal contribution over those 2.5 decades was $150,000. The market's invisible compounding contributed $340,000. In that final year alone, the annual return generates around $37,000. That's more than 6 times your annual input. The gap that was a frustrating $900 back in year 3 never stopped widening. It just widened slowly enough at the start that impatient people never stuck around to see it. This is exactly why patience is literally the highest-paying skill in investing.
But hey, we do have to apply some cold water here, because reality isn't a clean spreadsheet. A nominal $500,000 in 25 years isn't a $500,000 today. If we factor in a 3% historical inflation rate, that $490,000 has the purchasing power of roughly $235,000 in today's money. It is still an incredible wealth-building outcome, but you absolutely have to account for it. Then you've got hidden fees. If you use expensive, actively managed funds instead of cheap index funds, those fees will silently slice tens of thousands off your final number without ever sending you an invoice. And if you pause contributions, even for just a year, you lose out on decades of future compounding.
So the crucial point is how you interact with time. Consider 2 different investors. The first starts at age 25, doing $500 a month, and ends at age 50 with about $490,000. The second person waits until age 35. They realize they're behind, so they double their contribution to $1,000 a month for 15 years. Their outcome? Only $347,000. They put in way more money per month, but ended up with a worse outcome by over $140,000. You cannot outwork time. You cannot out-contribute it. The compounding window simply does not negotiate.
Which brings us to the ultimate realization today. The math on both of these machines, the housing market and the stock market, is running right now. The debt machine will gladly take 54% of your income if you let the banks do the math for you. And the wealth machine, well, it'll silently build an empire for you, provided you have the patience to endure the invisible years. Time and math are going to run quietly in the background, month after month, widening the gap whether you are actively participating or not. So knowing what you know now about how capital truly accumulates, will you wait for the machine to wake up?